I don't see any particular reasons that we couldn't be at the bottom. And I'm not trying to say that we definitely are at the bottom, but like, I think the unwinding that had to happen has happened. I mean, it's been an extremely messy, last month, obviously. And, uh, one of the interesting things um, is that this hasn't been just a crypto phenomenon. Like when you look at what's happening in markets, right, you see similar things happening in tech. You see similar things to some extent happening, all over the ecosystem where I, basically you just have a really large retrenchment of all of the gains that have happened over the last year plus in markets, and it was sort of triggered by the Fed initially by the expectation that rates were going to finally really start rising and rising more than people thought. But at this point, I mean, the carnage we've seen in markets, I think, is out of line with what 3% interest rates would normally represent.
Yeah, I mean, I looked at this, and actually, I use monetary tightening as in the rate of change of monetary tightening plus commodity prices plus inflation, all of this stuff, and the dollar. I think it's the largest tightening of monetary conditions in all economic history, as far as I can find, and it just happened really fast. So, yeah, as you said, this is not a crypto event. This is just a liquidity event, and it's happening. I mean, look at the oil market today. Everyone's super bull on oil. Last thing I heard, somebody had a $350 price target. It's down 10% today alone.
Yeah, exactly. And right, and it starts to get to the like, wait, shit, is it that everything is down because we need to spend all our money on oil, or is oil down because you don't have any money to spend left on oil? Like what's the narrative even anymore?
Well, I think it's a combination of the two, right? Because what you've done is created demand destruction.
Yeah.
But what's interesting to me is I think we're just shifting between what was inflation fears to now is what is a growth collapse. And for me, that's actually pretty bullish to the longer duration assets like tech that got smashed and crypto that got smashed.
At least it's less specific. I mean, look, everything applies to everything to some extent, but as long as the big fear was really on like inflation and liquidity, that specifically is going to hurt things that had huge capital inflows more than anything else. And it's going to hurt, as you said, longer duration plays relative to like oil and bread. But if it really is just an overall economic event, that will still hurt everything. But the spread is going to change there. And I also think, for what it's worth, that like people often get a little bit interestingly sort of like sidetracked when thinking about inflation, where it's easy to see the dollar, inflation in the dollar, and then you see all these graphs go up, and you're like, holy shit, that's like an enormous economic change. And then all of a sudden, the Fed starts tightening policy, and all the numbers go back down, and you're like, holy shit, but to some extent, it's just a stock split in the U.S. dollar, right? Like that's like one way to think about this. And if that's how you think about it, the whole thing's kind of like a little bit of a sideshow. I don't want to like sort of like state that point, but then when you start talking about the actual economy, about like, are we producing less shit now? Like that's real bad. And I think that is also a lot less of like something that hits the financial and financialized sectors, and more of like there's just less stuff now.
One of the things I've been looking at is I was in the markets. I was at Goldman during the long-term capital crisis and the Asian crisis. Right, this is what we saw in crypto was that writ large. It was so similar, where there was one or two players who had more leverage than expected amongst a number of counterparties. They all had one big client. That client blows up because of liquidity issues, and it takes everybody down. And we've seen this rule book. We've seen this play out before, right?
Yep. No, absolutely. And there's absolutely something like that going on here where, I think you look at the drop down to 30K in Bitcoin as really being just economically driven, like, and driven by macro. Like that wasn't very crypto specific. And even the Luna implosion, right? When you actually think about like how much did that affect crypto, the ecosystem outside of Luna, I think there's sort of a general sense of like anything whose like future was dependent on like an unpegged stablecoin definitely never decreasing that much in price. Like it sort of deserved to have like the ecosystem wasn't pricing in the core ecosystem wasn't pricing in that UST could never depeg. And so that I think was actually somewhat limited in terms of like the contagion effect that it had on the ecosystem. But I think when you just have an overall huge credit crunch, like we've seen, that's a more generalized effect, right? And now you're sort of moving from a world where you're talking about this mostly, as you said, in terms of the in terms of like specifically what is the the effect on like a particular few parts of it, to just everyone gets really stressed. Like every business has stress increased on a financial perspective. Um, and then you just sort of like add on top of that, that like that there are a few that actually fully blew out, right? And it's a recipe for contagion, because you have not just the literal contagion, but you also have people not having nearly as much capital to deal with it as you would during normal times.
Yeah, there was an old client of mine used to gave me an expression that stuck in my mind all the way through my career, which was "He who has cash in a recession is king." And it's like
Yep.
I can see that you're in the advantageous situation of having cash in a recession, and there's opportunity everywhere because the space is not the dynamics of the space haven't changed in the long run. It's it's a short term phenomena that leads to opportunity, I guess.
Oh, certainly. There's a lot of dislocation, and there are a lot of, potentially really good, plays that one could make here if you had infinite capital backing up, that. And of course, no one has infinite capital backing up anything. But there are still good plays if you have like significant but finite amounts of capital. And so I think that, one of the things we've been thinking about the most here is just like, given everything that's going on, like what should we be doing? Like where is it most important that we're deploying our capital right now?
And what's your answer to that?
Yeah, so one piece of this, and one of the pieces I think's gotten just the most attention, um, has been looking at places um, where basically you have like the sort of classic place that you want to look at is something that like would be totally fine except for a really nasty short-term liquidity crunch, right? The closer you are to that sort of like ideal, the closer you are to a place where from every perspective, it's that's where cash should be deployed, right? Both from the perspective of like, is there a good investment opportunity there? Probably, but more importantly, from the perspective of like, can you bail out some customers, bail out a company, and stop contagion from spreading in a way which is basically permanent, right? Because it's not like a business that had to go under. Like this is just like, there was going to be effectively an economically inefficient crunch in a business because of short-term conditions. So that sort of is a platonic ideal that we're looking for above everything else. And of course, nothing is a platonic ideal, right? Like everything is actually nuanced, and everything at the end of the day, um, it's all shades of gray, and we understand that, and we're not sort of like looking only at perfect systems. Um, but that's sort of where we start, and then we say, all right, like which places look mostly like that? Like there's like this is like, it's not just like a money pit.
No, it's not a holistic enterprise that's done just for the greater good.
Right. And so I think that like, we don't just want to be throwing good money after bad, on some of these things. But if there are cases where we can, where we can actually really, either surface, save a really good business, and or where, there's sort of like serious customer protection issues that we can help backstop. And then probably the biggest thing is like contagion that we can actually stop from spreading, right? Not just like bailing out contagion dollar by dollar, right? But like stopping a bunch of contagion with a smaller capital outlay, because it stops like the whole process from having to unwind. Those I think are the places that like we are most looking.
Yeah, and distressed investing itself is a very interesting opportunistic, opportunity in itself, and then being able to accelerate your roadmap by doing it is the double whammy, right? It's a perfect state where you can stop contagion spreading because you're the distressed investor, or there's a whole bunch of people who are, and then you get to accelerate the roadmap. Okay, that's a great opportunity.
Yeah, no, that's absolutely right. And that's, again, nothing is a platonic ideal, but like, the things that look at least the most like that are the places that we're most looking at. And the places that most look like there's a gigantic hole that's going to be hard to plug, and there's nothing there left beyond that hole, like that's all that's left, are the places where we feel more like it's not clear what there's left to do here. Like it's a shitty situation, but like it's not clear it's a salvageably shitty one. And so I think that sort of is the core the core sort of split there.